Hello everyone, and welcome back to another trading video or training video. And today we're going to be looking at some popular chart patterns. So I'll just be running through just a short video on some popular chart patterns, and then so that you can be able to identify them on the chart and then apply some of the other things you learn with regards to support, resistance, and price action. You can always apply it to it. So let's jump straight into it, okay? So here's the content of what we're running through today. So we'll look at the Forex market and the patterns, some more patterns in them, those different tradable patterns, and would basically see some examples on the slide here and how to trade them. Okay, now the financial market or the Forex market is full of charts. It's full of chart patterns that occur frequently in the markets. Now, if understood, you can start to see some patterns repeat themselves over and over again. So you see certain structures in the market, certain patterns, and they tend to produce certain results. So that's where the back testing comes into play. So chart patterns, is kind of like a shape within price where we can look at, it's more or less drawing a sample. So when you look at the stars and try to, form constellations and all of those things, it's more or less what we do with chart patterns. So we look at some popular chart patterns that tend to repeat themselves over and how we can deal with them. Now, here are some of the most popular chart patterns to learn. So in some later trainings, I would go in depth into almost all of them here. I think the majority of them are going to with several key examples, but we're going to just look at them, understand what they look like so that you can be able to identify them on your chart. So from channels to wedge patterns down to triangles, double tops, flags, and head and shoulders. Okay, so let's begin with channels. Now, as the name implies, it's a system. It's more like you look at the chart, if you can spot it. Now, the more you do this, the better you'd be. At first, when you look at the chart, you'd see nothing. You just see confusing candles, as if you're new. But over time, you start to see the patterns in the market, and I'll help you see how, with practice, you'll be able to get better at figuring them out. Now, one thing to notice in the illustrations, it might appear to be perfect, but in live market, it would not always be exactly perfect, but you should get the drill, right? Now, channels, they look like this. This is an ascending channel. That means it's a bullish structure. Where price is moving within a range. So these two green lines here are serving as boundaries within the channel. In a bullish channel or an ascending channel, preferably you want to be looking for buying opportunity. Why? Well, because the structure is bullish, so you're looking to buy support. Now you can obviously look to counter trend trades. As you get better and get more experience, you can look to maybe sell the retracements, but you want to stick to trading in the direction of the channel until you are better and more comfortable with trading. So in a bullish channel or an ascending channel, we're looking to buy supports. And then in a descending channel, we're looking to sell the resistance. And obviously in a horizontal channel, in this case, we can look to buy support, sell resistance, buy support, sell resistance. Now here's another key thing about channels, the market doesn't like to respect channels for too long. So if the market stays in a channel, it's usually going to want to break. And usually the follow-up breakthrough is quite immense. In a bullish channel, in most cases, the market wants to break down, right? If the market stays in a bullish channels long enough, more often than not, now the market would want to break below the channel support and then continue going down. So until that is broken, so when you're seeing the channel, your first instinct should be to continue to trade and buy supports. However, when support is broken, you want to be smart enough to understand that this could be the actual follow-through and then look to sell, because breaking of support would disregard this channel. And then if it breaks below the previous low, it would even make it more immense. And then in a bearish channel or a descending channel, market, when it breaks, usually tends to break out of the resistance and become bullish. But while the channel is in place, you want to look for opportunities to sell. But once the channel is broken, or the channel resistance is broken for a descending channel, then you can now start looking for buying opportunity. And then in the horizontal channel, this is usually a consolidation phase. There is usually no guarantee as to where price wants to go. There's no guarantee in that case, but in this one, you might want to look at the overall market structure before and then figure out if maybe a Y curve, you're having just some sort of Y curve accumulation. The market could decide to break down or break above. You just want to wait for the clear break and then look to trade that. Okay. So here's an example of channels in place where you can see now, just like I mentioned, you could see the example, the illustration was perfect, live chart, not so perfect. But you get the drill. But when it comes to drawing channels, you don't want to force it. You want to have at least 2 touches, and also you can see this is an up channel, a down channel, another up channel, a down channel, and a sideways channel. This is what you find that. I think I have another example. Yes, beautiful example of Euro USD. Now this one, I particularly traded this for a while, made me quite an amount of money. You could see how this is the euro against the dollar, the daily time frame, and you'd see how price was moving within this channel. You could see it's almost perfectly, right? Moving within this channel. Remember, because the structure is bearish, we're looking for selling opportunity. Some of you will remember these charts because we use these same charts when we were looking at support and resistance. And you'd notice that, well, so after the just like support, after you've seen this 1, 2, 3, 4 touch, you can draw the channel, and then remember, just the same way you would draw your trend line after 1, 2 touches. So you have already started watching these areas, and then, but in this case, it turns out that there is a parallel conjunction between the upper side of the trend and also the lower side of the trend, which is why it's a channel and not a trend line. So therefore, in this case, you could see how channel resistance is holding price down. So you would have been able to look for selling opportunity here, selling opportunity here, selling opportunity here, selling opportunity here, which also produce a bearish engulfing candle. You could find a bearish engulfing candle here, another bearish engulfing candle, another bearish engulfing candle. You could see, so this is how you combine the pieces of what you learn together, to make you even better. Now, eventually, nothing lasts forever. You could see where we broke above the channel, and what happened? Well, price has now begun to move upward, right? So this is a classic example of a channel, and it's been broken. So let's go to the next type of pattern, which is the wedge pattern. Now, as the name implied, it's a wedge. Think about a wedge, that kind of wedge that wedges your door. If you wedge something, it kind of looks like some sort of what I call it, unsymmetric channel. So a channel is parallel. That means it can keep going on forever. Theoretically, market price can stay within a channel forever. However, a wedge pattern is a terminal pattern. That means price has to break out of it sooner or later. So you can see this is a falling wedge where the market is making, it's going down, like it's making lower lows and lower highs. But each time the cycle is getting smaller and smaller and is staying within a wedge. Usually this type of pattern, a falling wedge usually is followed by a breakout to the upside, right? So a falling wedge pattern, when identified, usually signifies you wait for the breakout to the upside and then look to trade that. And then the other type of wedge pattern is the symmetrical wedge. There's also the rising wedge, which is also obviously the opposite of this, where it's a pattern where it's moving upward, but it's running out of cycles, and usually that is followed by a break to the downside. Now, a symmetric wedge is one where it's basically, you can't really tell if it's not making higher highs and higher lows. It's just making some sort of higher, so high, a higher low, but then it's making another lower high, and then this type of setup, it could break out either way. So you want to wait for the breakout either to the upside or the break below support and look for opportunity to sell. So that is for the symmetric wedge pattern, for the falling wedge, and also obviously for the rising wedge, which is the opposite of the falling wedge pattern. So this is an example here. You can see this is a symmetrical wedge, where this is the actual wedge height. And now another key point is when it breaks out, when the market breaks out of the wedge, either up or down, usually it tends to move at least the height of this initial wedge start. So from here to here, the amount of pips will probably be the target from when the breakout occurred to where we try to target for profit. Okay, so you could see price moving within this wedge, and eventually we had this breakout and confirmation. And obviously, this is where you start looking for your bullish engulfing candles or bullish setups to serve as confirmation once this breakout has occurred to then take price higher. Okay, and now the next pattern we'll discuss is the head and shoulder pattern. There's the bullish head and shoulders and the bearish head and shoulder pattern. Now, just as the name implies, so it's like a human head. So let's look at the bearish because it describes it very well. So imagine you're standing, your head is above your shoulders. So you have your left shoulder and your right shoulder. So a bearish, right? This is a bearish head and shoulder because it's bearish because it's a sign that price wants to go down. That's once it's completed. So imagine price has been going up, and then we have price make a high, and then made a higher low, so it's still bullish, and then made a higher high. Now price now comes down and makes an equal low. Now this low doesn't exactly have to be equal. It could even be at a diagonal, but then makes an equal low and then goes up to make a high that is also lower than the head. And therefore, so we're looking at this. Once you're looking at the head and shoulder, you're waiting. What are you waiting for? You're waiting for the break of the right shoulder. If the market does not break the right shoulder, then there's no trade. But if the market, in this case, since this is the bearish head and shoulder, breaks below the right shoulder, well, that break below the right shoulder is the confirmation you need. So you can now start looking for selling opportunity. You can keep your stop loss above here or just above that structure and target the length or the number of pips from the head would usually be the number of pips to the bottom. Now, it's not always guaranteed, but you can use that as a benchmark. And then for the bullish head and shoulder, or sometimes called inverted head and shoulder, you can see it like a man upside down. This is the head, this is the left shoulder, this is the right shoulder. We'll wait for the break above the neckline. So this is the neckline. And then retest of that usually will serve as confirmation to continue going upward. Okay, so this is an example. Price is bullish. We have the left shoulder. Now, the left shoulder and the right shoulder doesn't have to be equal, right? The point is that the left shoulder should be lower than the head. The right shoulder should be lower than the head, and there should be a neckline that connects the left shoulder to the right shoulder. And then once the break occurs, you can use that as a reason to get involved. Selling, so you can sell at the break of this, and then stop loss above there or just above this candle and target the widths, right? And then this is an inverse head and shoulder or a bullish head and shoulder, where this is the left shoulder, this is the neckline, the head, this is the right shoulder, and this is the neckline, and you can see the break above, retest, and continuation. So with the head and shoulder, the safest place to put your stop loss is just above the neck, the right shoulder. But obviously, depending on how far away that is, you might need to break it down even further and use more confirmation to get involved. Okay, so the flag pattern is the next one we'll talk about. Now, the flag pattern is a combination of something like the channel plus a structure. So this is what the bearish flag pattern is. So it's like the market is bearish, and then all of a sudden begins to stall, right? So it's like sellers were having a good time. They pushed price down, but then they have to catch some breath. They have to catch their breath. So that's why you see price moving within a channel. So this is a channel, right? You could have maybe traded the channel itself. But then remember, it's like I mentioned, a bullish channel usually signifies is usually followed by a bearish break. So for a flag pattern, you can see this is like a flag pole, and this is the flag itself, and it's followed by the breakdown. Now, the bullish flag is like this: market is bullish, then the market begins to move within a channel, stall for a bit. Once you can identify that channel, you can start waiting for the break above it, and then you can then use that to trade. Once we have break and confirmation, your targets would be the same length as this. Now, it's not always going to be guaranteed. And then your stop loss, at least if you're aggressive, should be below the flag low here. This, not this low, but this, the actual flag low here. But usually I'll look for more confirmation outside the break and then use that to do the trading. This is an example of a flag pattern. The market's bullish. Then you can see the market moved within a channel for a bit, broke out, and then began to move up in the opposite direction. So 500 pips, flag, channel, the channel, and broke out from here to here. So not from here, from the low to the high would almost match from this low to this high. So when the break occurs, you can then look for an entry. You can keep your stop loss like here, and then go after the measured objective. Okay, so the other one we'll discuss here is the double top and the double bottom pattern. Is just more like support and resistance, where price is going up. So in this case, price would have been appreciating for a while. So when you see a double top, it's usually a sign for a reversal. A double top is a sign for a bearish reversal where price is going up, and we have this top and then price comes back and then goes back again, but fails to take out that area and then begins to pull back. So once that break occurs, we can then start to look for selling opportunity, especially once we have the break below this previous low here. We can start looking for selling opportunity. Obviously, if you're aggressive and as you get more experience, you can start looking for much earlier. Now, the double bottom is a bullish reversal pattern where the market would have been bearish for a while and then comes into an area of support, fails to break, rejects, comes back, fails to break, gets rejected, breaks above, and then we can start looking for sell opportunity. Sorry, for buy opportunity. Here's an example of a double top. You could see here that we had the first touch here from area of resistance. Again, price failed, and then we had the break of this area, the breakdown, and this is where we begin to look for sell opportunity. Don't worry, as you get better, as we progress in our trading, we'll see some more examples, of this in the live market, in some of our subsequent trading or training videos. Now, the next one is the triangles, the ascending and descending triangles, similar to like wedge. So an ascending triangle, it's you can identify this one because by the formation, the market is in an uptrend and then gets to a level of resistance and then begins to, it's still, you can see it's making higher lows, but it's not making higher highs, right? So it's in like this flat triangle, right angle triangle, where it's making higher lows, but it's not making higher highs. And it's a terminal pattern because at some point it has to decide to either break down and fall or break up and continue. So in most cases, it tends to break up, but you don't want to start trading before it. You want to see confirmation before you start trading to the upside. But a pattern like this is followed by a break to the upside, and the opposite would be for the descending triangle, where the market is in a bearish, is already bearish. It's now making lower highs, but it's failing to make lower lows. And at some point, the pattern will get terminated, and we could now continue the overall bearish trend. Okay. And then here's an example of an ascending triangle bullish market. It's making higher lows, but it's making equal highs, or more about equal highs. And then we had the break and the push continuation. Okay, so those are the examples on chart patterns. Don't worry, this is just to introduce you to some chart patterns so that once you're looking at your MT4s and you're looking at your trading views and stuff, you'll be able to start identifying some of these setups and how you can approach them, and what you should be looking to do, what opportunities you should be looking for. I will be breaking down some of this in some subsequent videos as we go forward. So I hope you enjoyed the video. I'll see you in the next one. Have a good one.